So we all know that investing in the stock market carries risk. And I want to discuss my personal strategy today. My personal strategy in my own portfolio. I have 37 dividend-paying stocks, and I want to discuss the very steps that I take to mitigate risk, the steps that I take to lower my level of risk. My strategy is multi-tiered. I have a variety of different levers that I use to manage my risk. And this is really a top-down strategy. Here on my channel, PPCE, and this is a thriving community of dividend growth investors, I do a lot of bottoms-up analysis. I'm looking at specific stocks. I'm analyzing specific stocks. Today's video is a little bit different. It's more of a top-down approach. I'm taking a portfolio-wide view, and I'm looking overall at my portfolio, how I mitigate risk. And this is actually a recent subscriber question, so I'm really excited to queue this video up. Actually, a subscriber asked me this question just the other day, and I just had to do it because the subscriber is spending a lot of time investing in his education. He's reading this book, Poor Charlie's Almanac. This is the book of Charlie Munger, Warren Buffett's famed business partner. And I actually have the book right here. It's funny, this is a gift that I received. I've actually not read the book yet, but I've got a signed edition. Check that out. There's Charlie Munger's signature right there on the opening page there of the book, so I'm really excited about that. I've got to read this, and this subscriber actually really piqued my interest with this particular question. And the subscriber basically said, "Hey Ian, I'm reading this book, and Charlie Munger basically says that there are cases out there where stuff just comes out of left field. There are things that you never envision. There are things in life and investing that just come into the forefront of your investment portfolio that you could have never saw before." And I look at that as risk. With investing, there's risk. There's things that can come up. Even Charlie Munger acknowledges that despite all of his best efforts, Warren Buffett's best efforts, there are things that come to the forefront in their portfolio that they didn't expect. And so how can one deal with that? How can one position themselves for that? That is what today's video is all about. So welcome to the video. Thank you again for the amazing subscriber question. I really appreciate the question. Great one. And I have so many questions. I am doing my best to get through each and every one of them, so I'm excited to do another subscriber request video. So let's get started. First and foremost, I have talked about this before. If you've been on my channel for a while, I don't want to spend a lot of time here, but inherently, dividend growth investing, this is investing for dividends like I do, dividends that come in that can be used to pay the bills. Something as small as going out and buying a cup of coffee at Starbucks, or something as big as paying for one's mortgage payment or one's apartment rental costs as well. There are all kinds of uses of dividends, and I invest for dividends. When I buy a stock, the only thing I'm looking at is how much income will that stock pay me over time. And as the company grows, as it grows its dividend, will my dividend income increase? That's all I look at. I don't look at stock prices in terms of capital appreciation. It's just I'm not looking to buy low and sell high. And so let's look at this. By nature, dividends take away risk. Why is that? In this chart here, I have two lines. I have one that's price per share. As we all know, PPS, price per share, for any given stock, it can be all over the map. When one looks at over time, ups and downs all over the place. If one is relying on price per share to pay their bills, that can be a little bit tricky, because what if one buys here and then, oops, right here, the mortgage is due, or down here, I've got to sell some stock to pay my property taxes. There are so many challenges with that strategy, in my personal opinion, especially looking at shorter periods of time, that in my opinion, it's a no-brainer to go the dividend route. Now, by contrast, let's look at this line. This red line is dividends, and dividends for the types of companies I own, like McDonald's, for example, they typically raise the dividend each year, and they have done this for over long periods of time. And so despite where the price per share is, despite where the share price is going, my dividends are a stream of income. It's typically up and to the right. And that alone takes away the risk, because I just don't care where the share price is. I surely care from an entry point. The lower the share price, the better my entry point, the better my starting yield. So I love it when the share prices are down. And certainly over long periods of time, I like to see the share price up, because it's indicative that the company is doing well. It's just another way of measuring company performance. But in the short run, medium run, share prices up and down, I take a lot of comfort that my dividends are up and to the right. And so investing in dividends, investing for dividends, for that cash flow alone, having that as my strategy, it just takes away so much inherent risk in the stock market as long as I don't need my principal. I don't need to sell the stock to make a profit. And so that alone is why I invest in dividends. But we've talked about this before, so I don't want to spend too much time. I want to move on now to my diversification strategy. It is so important, in my opinion, to diversify. And a lot of people think about diversification the wrong way. This is actually why I wanted to do this video. A lot of people start more like bottoms up. They just start buying stocks and they're like, hey, I'm buying whatever's on sale. I'm buying whatever is attractive at the moment. And I'm doing that to diversify. However, I think a lot of people, they're not always achieving the goals that they want to because they're not thinking about things more from a top-down approach. And so I want to go from my top-down approach, and you'll see how it's very different from just picking and choosing different stocks, more of a bottoms-up method. So check this out. First one is just time. It's important, in my opinion, to diversify by time. What does this mean? Let's say I have $50,000 right now and I want to invest it in the stock market. Well, if I take that $50,000 and I put it all in tomorrow, that is not diversifying by time. That is taking a lot of risk. I am assuming that tomorrow is going to be a great entry point, but I just don't know that. What I've always found is dollar cost averaging is a great strategy. If I have some money, I'm going to deploy it in the market. Why not take that $50,000 and put it in slowly but surely over time, a little bit each and every month until I'm fully in. And I've done a video actually on how I would hypothetically invest $50,000 if I were starting all over again. I'm going to link in the description below to that video if you want to check it out. But basically, this is the concept of time. Time diversification is more important as one's portfolio gets bigger and as one's amount of money they're deploying gets bigger. Let's say I was hypothetically starting over again with $1,000. I would not diversify by time. I would just get that $1,000 working for me immediately because that would be my first stepping stone in terms of adding more to the market. But again, as sums of money get bigger, and let's say I had $50,000 or $100,000 or even $500,000 hypothetically to invest, I would certainly want to diversify by time. I would personally take the money, divvy it up, and deploy a little bit each month. And of course, as the sum of money getting deployed gets bigger, the more time it will take to deploy it all. And that way, I mitigate some of the market risk. Price per share of various stocks or of just the market overall tends to go up and down. I'm not taking a big bet on any one moment in time. And I think this is huge. This is something that goes lost on a lot of investors out there. I think dividend investors generally get this, especially because this is typically how, if one does participate in dividend reinvestment plans, I'll link in the description below what those are all about. Those tend to cater to these types of investors who want to diversify by time like myself. Anyways, let's move on. Industry. So don't look at the companies right now. Don't look at the stocks that I have listed here. Let's just start with industries. Before I do anything, when I am creating a portfolio, when I am planning my portfolio, I'm determining how this portfolio will be, I like to put aside the companies at the beginning, and I start just thinking about industries. What industries do I need representation across to achieve diversification? These are not all of the industries that I have in my portfolio, but these are the ones I've discussed so far on my channel. So I wanted just to use familiar industries that I've already discussed here on PPCE. And I own stocks in healthcare, consumer non-cyclical, industrials, restaurants, utilities, real estate, energy, chemicals, technology, a lot of different industries. This is really important to think about industry before thinking about company, because if one just thinks about company, they may pick a bunch of different companies thinking they're diversifying, but then they look back and they're like, wait a minute, all these companies I have, they're in the same industry, they're all utilities. If someone just buys a bunch of utilities, that's not really going to diversify one's risk away, because the utility sector, more or less, will probably perform most of the stocks in tandem. They will tend to perform in lockstep. Surely there will be winners and losers, and I like to diversify within industry. We'll get to that in a minute. But before diversifying within an industry, it's mostly important, in my opinion, to get representation across most of the major industries. Now, maybe there's a certain industry you don't like, you don't feel comfortable, you don't like it at all. You don't have to have all the industries, and in fact, I'm missing certain industries. I'll tell you one industry actually that I am missing right now in my portfolio is insurance. I have nothing against the insurance industry actually, I just don't have representation, and so that's an industry I'll probably add in the future. It may be sooner than later, but right now I don't have representation in that industry. So you don't need every industry. I don't need every industry to achieve diversification, but I surely like having representation across a broad array of industries. So next, once I picked out the industries, that's when I start picking stocks. And here is a representation of just some of the stocks that I have shared on my channel. Now, I own 37 stocks. This isn't all of them. This is a good chunk of them here. Healthcare, for example, I own Johnson & Johnson and Pfizer. Consumer non-cyclical, Pepsi, Procter & Gamble, Kimberly-Clark, Clorox, General Mills, and Campbell's Soup. So on and so forth. Here's where it gets interesting. Once one has diversified by industry, it may make sense in certain industries to have representation from more than one company, especially if it's a pillar industry. It's one of your favorite industries. It's an industry that is a bellwether within the portfolio. If you've been following me, you know I'm all about consumer non-cyclical. I love consumer non-cyclical. So just here alone, I actually have more than this. I have more stocks than this in consumer non-cyclical. But you can see here, 1, 2, 3, 4, 5, 6 of them listed here. Now, what's important to notice is some of these industries are broader reaching in scope than others. Consumer non-cyclical is a great example of that. Pepsi, for example, makes food and beverages. Procter & Gamble makes household goods. Kimberly-Clark, household goods and also goods that are used in industry, paper goods. Clorox, cleaning supplies, but they also have some new other products as well, like the Burt's Bees line, and I think they own Glad bags as well. So they've got a few different lines, one in the beauty, mostly in kind of cleaning type of stuff. General Mills, Campbell's Soup, food. So you see here, if I had to bucket them, Pepsi, General Mills, Campbell's Soup, they're kind of all in one bucket, general like the food bucket. But in terms of kind of cleaning, household goods type stuff, I've got Procter & Gamble, Kimberly-Clark, and Clorox. And so this is really important. When one has already picked their industries, one has already decided, hey, I'm going to diversify by time, now I'm going to start picking companies, it's really important not to just pick all the same companies. For example, if I was starting over again and I was buying my consumer non-cyclical stocks, would I want to just buy Pepsi and General Mills and Campbell's Soup? Probably not. If I had a smaller portfolio and I was just starting out and I wanted a few stocks in consumer non-cyclical, I would probably buy one food stock, maybe Pepsi, and then maybe I'd start with something else like a Kimberly-Clark to kind of diversify into consumer goods. And so it's really important to think about things that way. And again, the approach of just coming bottoms up and picking a bunch of companies, it doesn't always achieve diversification because one may actually be defeating themselves. They may actually be buying the very stocks that are all similar. Coming from bottoms up, they may say, hey, Kimberly-Clark is on sale right now. Procter & Gamble is on sale right now. Oh, Clorox looks good. And then all of a sudden, one might think, hey, I own 3 stocks. I'm kind of diversified. Well, not really, because they're all in the same industry, and within that industry, they all do more or less similar things. So moving on, you'll see some of these industries here. I don't need quite as much diversification because some companies are just so diversified in themselves. I'll give you an example. I'll start with my favorite company, Johnson & Johnson. And I'm going to link to some videos in the description below. I have videos representing a lot of these companies already on my YouTube channel. If you want to learn more, check out the link in the description below. We'll go through those in great detail. But Johnson & Johnson is a big company, $326 billion market cap. They have business units across pretty much everything as it comes to health, well-being, medical, pharmaceutical, medical devices, all kinds of stuff. And so in healthcare, for example, I could probably be fine just owning Johnson & Johnson. And this has actually been my strategy. I own Pfizer too, but I've got the lion's share of my money for the healthcare sector in J&J. And I feel good about that because it's diversified within itself. However, let's take a different look at another company like consumer non-cyclical, Campbell's Soup. Yeah, they've got a lot of products and it's pretty well diversified, but it's a smaller company. They're pretty dependent on certain product lines at the company. Is that going to get me the diversification I need to represent the entire consumer non-cyclical bucket? No. And so it's important to look at things that way as well, as how diversified is a particular company. And if a company is not that well diversified, sometimes it makes sense to pick up other companies in the same sector to give yourself that diversification. Another way I like to diversify is based on market cap. So These companies all have different valuations, different market capitalizations. The market cap is the number of shares outstanding times multiplied by the price per share. It's how much aggregate value is the company worth. Like I said, J&J, $326 billion. That's a big company. But there's other companies that are smaller, like Southern Company, one we've talked about here a lot, $47 billion. And even smaller, Realty Income, the company that I own that pays a dividend every month, the monthly dividend company, $15 billion. I like to diversify by market cap because there's certain market cycles where mega cap stocks do well, certain market cycles where mid cap stocks do well, certain market cycles where small cap stocks do well. I like a portfolio where I see stocks going up and down at the same time. They kind of cancel each other out. They mitigate some of the risk. And I have always found that having a diversification strategy where everything is the same, they're all mega caps, that just doesn't work for me. I like to have small caps like Realty Income, mid caps like Southern, and large caps like Johnson & Johnson. I diversify by market capitalization when I'm building my stock portfolio. What else? Quantity of positions. This goes without saying, but in general, the more positions, the more diversified one's going to be, the more risk is going to get mitigated away. I own 37 positions. If something happens to one of the companies in the portfolio, it's not going to make or break me. If it were my number one stock, Johnson & Johnson, and something horrible happened, like the company folded, certainly that would have an impact on the company because I have a good chunk of the portfolio in there. That being said, it still wouldn't make or break me because I diversified so well. Here's what it comes down to. I love having a lot of positions in the portfolio, but at the same time, it can become a management overhead. At a certain point, enough is enough. And I have found at 37, I'm getting there. Adding one or two more, I'll probably do it. Like I said, at some point, I want exposure to the insurance sector. That being said, I am in no rush now to add more positions because it'll be a management nightmare. That being said, having too few, I would have the opposite challenge. I would be a little bit more worried, a little bit more concerned about being able to weather any storm. Like Charlie said in Poor Charlie's Almanac, it's just these curveballs. They can come your way. You don't know what's coming, the unexpected. Well, by having 37 stocks, I can weather the unexpected. And I can weather the unexpected even if it happens to several of my positions at one time. So I like having 37 positions. And when I have my 37 positions, I like to think about how I will weight them. Some of them I weight as core positions, some medium, some small. I do that to mitigate risk as well. And I'm going to link in the description below. I have a whole video about that strategy, how I like to weight different stocks in different buckets. A lot of it just comes down to which stocks are the best in core positions, which ones are kind of medium, steady players, which ones are just more ancillary. I want exposure, but I don't feel quite as comfortable adding more money as I would to my more favored companies. But anyways, just by having 37, and a lot of them are, a good chunk of them represented here, it just gives me that peace of mind that, look, even within the same industry, a certain company, maybe just something really wacky has happened, something really weird. Having that diversification surely helps. Anyways, I'm going to move on now. We're talking about how to mitigate risk. What I've talked about so far mitigates risk within the portfolio itself. But there's other types of risk in life. You know, certainly my stock portfolio could be doing great, but what if an unexpected bill comes up? What if something unexpected happens at the job? What if something just unexpected happens that requires a lot of money? Well, I have come to realize in 2018 that it is really great to have an emergency fund. It is really comforting. It is really nice to have an emergency fund. It was not always that way for me. I'll link in the description below. In most of my years of investing, I went all in. Never had an emergency fund. I'm glad I did it. When I was younger, when I didn't have kids, when I could take on a little bit more risk, I just went all in, and I wanted to because I knew the market was at really depressed levels as well, and it was a good buying opportunity. But over time, the market has gone up. My life has changed. I have 2 beautiful kids now and a wife. And so I have responsibilities. And because I have those responsibilities, it's really important to have an emergency fund. It helps me sleep at night. It helps me weather the unexpected. And surely if something unexpected happens, I don't want to have to sell stocks. And so look, my emergency fund right now, it's still just getting off the ground floor, but I'm adding to it every month. And it's something that's at top of mind. It's actually been challenging for me, quite frankly, because whenever money rolls in, my natural reaction is to put it in the market. I just can't stop buying dividend stocks. I actually link in the description below. I did a whole video about this. I get I get to this point where I just have to buy dividend stocks. I can't get enough of it. And I've had to be very conscious this year and very much exercising self-control to earmark the money for the emergency fund and not deploying it all in the stock market. And so that's been a new challenge for me, but it's important because I'm all about mitigating risk at this point. It's really important to me at this stage in my life, and I'm really thankful for the emergency fund. One of the other things I want to mention is other assets. How can one mitigate risk? Well, maybe it's not all about dividend stocks. This is kind of an interesting point. It's a nuanced point. If you've been following my channel, you know I'm all about dividend stocks. That's my thing. Sometimes I dabble in angel investing as well, a smaller sliver of my portfolio. And I'm actually am a proponent as well of retirement accounts as long as they provide some unique benefit. So one example of a unique benefit, does the employer offer an employer match? Another unique benefit is, does the retirement plan potentially allow one to defer taxes? Maybe it's a pre-tax retirement plan. Another example of a retirement plan that may make a lot of sense is maybe it's a retirement plan that allows one to compound money tax-free. Anyways, one thing I have come to realize over the years is too many accounts is a management nightmare. It's just a management overhead. It is too complex, too confusing to manage. But at the same time, too few accounts could expose oneself to risks. So what I have come to terms with is have the great dividend strategy, have the emergency fund, pepper in a few other assets, not too many, but a few strategically where it may make a lot of sense. So this is my fun video here on mitigating risk today. Thank you so much for watching, and thank you for that question. That was a great subscriber question. It was really fun leveraging poor Charlie's Almanac here. Now my interest is really piqued. I really want to read this thing. This is a big book, by the way, thick book. This will be a fun one. I got to read it. I got the signed edition, so it's been on my to-do list forever. Before I leave today, I want to add a full disclosure. I own the stocks mentioned in today's video, so I am long. I own Johnson & Johnson, ticker symbol J&J, Pfizer, ticker symbol PFE, PepsiCo, ticker symbol PEP, Procter & Gamble, ticker symbol PG, Kimberly-Clark, ticker symbol KMB, Clorox, ticker symbol CLX, General Mills, ticker symbol GIS, Campbell Soup, ticker symbol CPB. Wow, this is getting interesting. United Technologies, ticker symbol UTX, 3M, ticker symbol MMM, McDonald's, ticker symbol MCD, Starbucks, ticker symbol SBUX, Southern Company, ticker symbol SO, Realty Income, ticker symbol O, BP, British Petroleum, ticker symbol BP, Air Products and Chemicals, ticker symbol APD, and finally, IBM, ticker symbol IBM. Wow, okay, those stocks I own, they're all in my portfolio in terms of full disclosure. Also, before I leave today, just a friendly disclaimer, I am not a licensed investment advisor. Today's video is just for fun and entertainment. Today's video is not investment advice. Before you go out and invest in the stock market or anywhere else, please do consult a licensed financial advisor first. Thank you so much for being here today, for being part of the PPCEN community. Please leave your comments below. I would love to see, how do you mitigate risk? How do you think about risk? Is risk important to you? Do you not care about it? This is my strategy on how I mitigate huge risk in the stock market, and I can sleep well at night knowing that I've done my best to mitigate risk. I will see you in the next video.